A staggering U.S. jobs report revealed only 57,000 jobs were created in June, far below expectations. This shocking data has sent ripples through the financial markets, altering investor sentiment and Federal Reserve strategies. Here's what you need to know. Looking ahead, the Federal Reserve will be closely monitoring energy price trends and inflation data to determine its interest rate policy. Recent fluctuations in oil and gas prices have raised concerns among economists, as energy costs directly impact consumer spending and overall economic growth. Investors are eager for indications of future Fed actions, particularly as the earnings season approaches. Companies such as Rivian, which recently raised their delivery guidance for 2026, are set to report their second quarter results on July 30th. This will be a critical test of market sentiment and investor confidence in the electric vehicle sector. Analysts suggest that the current market rotation into small caps could be indicative of a broader shift in investment strategies. Continued volatility is likely as investors navigate the mixed economic signals stemming from inflationary pressures and interest rate uncertainties. Small cap stocks, often viewed as more sensitive to domestic economic conditions, may benefit from a more cautious Fed stance that prioritizes stabilizing growth over aggressive rate hikes. The potential for a slowdown in interest rate increases could provide these companies with a competitive edge in attracting investment. However, challenges remain, including supply chain disruptions and geopolitical tensions, which could dampen growth forecasts. The mixed signals from various sectors, including technology and consumer goods, complicate the financial landscape further. As companies report their earnings, the focus will be on how well they can adapt to these changing conditions. Looking forward, the question remains, how will these economic developments shape the financial landscape in the coming months? Investors will need to remain vigilant, as the interplay between Fed policy and corporate earnings will be crucial in determining market direction through the rest of the year. The path leading to today's disappointing jobs report has been complex and multifaceted. In the first quarter of 2026, the U.S. economy grew at a 2.1% annual pace, surpassing previous estimates and instilling hope among economists. However, hiring momentum has faltered significantly in recent months. The ADP reported only 98,000 new jobs in June, marking the smallest increase in 3 months and raising alarms about the sustainability of economic growth. Earlier this year, tech stocks had enjoyed a surge driven by optimism surrounding artificial intelligence advancements, which had fueled expectations of robust job creation in tech sectors. Yet, the recent jobs report has exposed vulnerabilities in the labor market, leading to a correction in AI infrastructure stocks. Additional volatility was introduced by specific events, such as Meta's ambitious entry into the cloud computing industry, which has raised competitive stakes and shifted market dynamics. Compounding these challenges, a substantial antitrust fine against Google by a European court has added to the uncertainty surrounding major tech players. These developments have not only contributed to investor anxiety, but have also cast a shadow over the broader economic landscape. The impact of these factors is significant, as businesses may become more cautious in hiring, potentially leading to a ripple effect across various sectors. Consumer confidence, which plays a crucial role in economic recovery, could also be jeopardized if job growth continues to stall. Looking ahead, analysts suggest that the Federal Reserve may need to reconsider its approach to interest rates, as sustained economic growth will depend heavily on a revitalized labor market. With the potential for further fluctuations in the tech sector, stakeholders will be closely monitoring upcoming economic indicators, hoping for signs of stabilization and renewed hiring momentum in the months to come. The implications of the latest jobs report are profound and multifaceted. The report revealed weak job growth, which diminishes the likelihood of an immediate interest rate hike by the Federal Reserve. This development gives the Fed additional time to assess whether a recent decline in energy prices will sufficiently curb inflationary pressures in the economy. Historically, the Fed has responded to inflation with rate increases, but this jobs report complicates that approach. Investors are already reacting to these signals, leading to a notable market rotation from tech-heavy stocks to smaller capitalized sectors. For instance, Meta's shares surged by 9% amid positive developments in cloud computing and artificial intelligence, showcasing the potential for innovation-driven growth. Conversely, companies like CoreWeave and Nebius saw their stocks plummet by 14 to 17%, reflecting the volatility that can arise from shifting investor sentiment. The conflicting signals of slowing job growth, combined with a stable unemployment rate, create a complex landscape for investors. While a stable unemployment rate suggests a resilient labor market, the lack of new job creation raises concerns about economic momentum. This situation is particularly pertinent as we approach earnings season, when companies will report their financial performance and provide guidance for future growth. Weak job growth can lead to reduced consumer spending, which is a critical driver of economic expansion. If consumers feel uncertain about job security, they may curtail spending, which in turn can affect businesses and employment levels further down the line. Moreover, the broader context includes ongoing global economic challenges, such as supply chain disruptions and geopolitical tensions, which further complicate the economic landscape. The Federal Reserve's decisions in the coming months will be pivotal. If the Fed decides to maintain the current interest rates, it could foster an environment conducive to growth. However, if inflation remains stubbornly high, the Fed may be forced to reconsider its stance, potentially leading to higher rates and further market adjustments. As we monitor these developments, the upcoming earnings reports will be crucial for gauging corporate health. Investors should prepare for potential surprises, as these dynamics continue to evolve in a rapidly changing economic environment. The U.S. labor market delivered a disappointing report today, with only 57,000 jobs created in June, sharply missing expectations of 120,000. This marks the lowest job creation in 4 months, raising concerns about the sustainability of the economic recovery. Surprisingly, the unemployment rate fell to 4.2%, but this decline is misleading. It primarily stemmed from 720,000 people exiting the labor force rather than new job growth, suggesting underlying weaknesses in employment. Additionally, previous job data was revised downward, further indicating that the recovery in hiring is far from robust. These figures contrast sharply with earlier optimism surrounding the labor market, fueled by post-pandemic growth and government stimulus measures. Analysts had anticipated a steady rebound, particularly in sectors such as leisure and hospitality, which have been crucial to recovery. However, this latest report raises questions about the resilience of the labor market and the broader economy. Initial reactions in the stock market reflected this concern, with major indexes dipping in response to the disappointing job numbers. The Dow Jones Industrial Average, for instance, barely moved as investors digested the implications of the report. However, early trading on Thursday saw a reversal as investors adjusted their expectations regarding the Federal Reserve's interest rate policies. The stark contrast between actual job creation and expectations has sparked uncertainty among economists and investors alike. Many are now speculating whether the Federal Reserve will reconsider its plan to taper asset purchases or raise interest rates in response to this data. The impact of these job numbers extends beyond Wall Street. They reflect the challenges faced by millions of Americans still struggling to find stable employment. The decline in labor force participation raises alarms about potential long-term economic consequences, including diminished consumer spending power. This situation could hinder economic growth, as consumer spending accounts for a significant portion of the U.S. economy. Looking ahead, the focus will remain on upcoming economic indicators and Federal Reserve meetings. Policymakers will need to assess whether the labor market can regain momentum in the coming months, or if further intervention is necessary to stimulate job growth. The next few weeks will be critical in determining the trajectory of the U.S. economy, particularly as businesses and consumers navigate these uncertain waters. With the Fed's next moves in question and earnings season approaching, how will these economic developments influence the financial landscape? Share your thoughts in the comments and subscribe for daily deep dives.